Hello and thank you for joining us for the fourth quarter market update. My name is Jason Gunkel and I lead our investment team here at Severson Strege. Today we have a special guest with us. We have Lance Gunkel, who is our managing director and also another member of our investment team. Lance, thanks for joining us today.
Thanks for inviting me on this sunny day in December.
Yeah, you bet. Well, it's been another good year for the market as a whole. Luckily for us, it's been a little bit less exciting. Last year we started the year with a very big drop, and then the market recovered. And the recovery, luckily, has really lasted through this year as well. So again, we're looking at over 20% returns for the U.S. stock market. Now, we are recording this a little bit before the end of the year on December 20th. So we can just cross our fingers and hope we have a good finish to the year as well. So we've had another strong year. And Lance, could you provide us a little insight as to why we've had such a strong year again?
Yeah, I can focus in on a few factors. The first would be rising home prices. Really, since the pandemic, we've seen growth in home prices throughout the country. In fact, as of September, we saw a year-over-year growth of about 19.5%. So this is driving an increase in home equity, which allows consumers to draw on that home equity for larger purchases such as washers and dryers or home remodels, things that are big ticket items. So this is driving some of that growth. Another driver would be strong earnings. Companies in the U.S. are recording record levels of profits. In fact, in the third quarter, 82% of companies that comprise the S&P 500 either meet or beat analyst expectations. So strong earnings growth has resulted in strong stock performance in the U.S.
Yeah, and Lance, one thing that's really changed since the pandemic is the job market. We know a lot of people are working remotely now. But can you give us kind of the landscape of the job market and how it looks as far as employment and as far as the number of people looking for jobs?
Yeah, we saw a huge spike in unemployment during the pandemic, and thankfully that's come down. I think the latest figure is about 4.8% unemployment rate. And the good news is that if you're a job seeker, you're probably able to find a job. Now, on the downside, it's creating some labor supply issues. Companies in certain industries, particularly retail and service, are having a difficult time finding enough workers to fill all of their available time slots. And part of that is due to the large number of people that are withdrawing from the job market, which is creating some changes in the wage landscape, which maybe you can speak to.
Yeah, absolutely. So those type of jobs that you mentioned, those retail and service type jobs, they tend to be lower paying jobs. But according to the Boston Fed, who did research on this, they found that those workers tend to spend almost all of that income. So about 97% of the income that they earn, they tend to spend it. So this puts a lot of upward pressure on inflation. There's kind of two sides to inflation, and this side, the wages, we think will tend to be more permanent. So once you've raised someone's wages, it's very hard to come back and lower them. So that'll have a long-lasting effect on inflation. The other side of inflation, which is really the supply chain issues, the factories that have been shut down because of the pandemic or some of the shipping problems that we're having because of the pandemic, those could last through next year, but they tend to be more temporary in nature where we think it'll work themselves out. And our long-term view on inflation then is actually much more positive. We think over the next 5 to 10 years, inflation will come back down and average maybe closer to 2.5% to 3%.
And part of the reason for that belief, Jason, is that the Fed is keeping such a keen eye on what inflation is doing, and they do have some power to affect that with interest rate changes.
Absolutely, and we got some news last week that the Federal Reserve has said that they expect to raise interest rates 3 times next year. So this is a little bit different than what we originally thought. We originally thought interest rate increases might come at the end of next year or into 2023. Now the expectation is that we'll have 3 interest rate increases at least next year. And that should keep inflation under control, but it might also slow down the economy. So Lance, inflation might be here to stay for a while. And how have we adjusted portfolios, or as we look at next year, how will we look to possibly adjust portfolios to protect them against this rising inflation?
Yeah, our investment team, which you're part of, we look at asset classes and how they perform in periods of both high and low inflation. And in high inflationary environments, the best performing asset classes tend to be those that include hard assets. And so there we're thinking of real estate, commodities, and we include in that group emerging market stocks because those countries tend to be heavily impacted by natural resources. But in addition to those 3 asset classes, we still like equities, both US and international, because they still provide strong returns, historically speaking, whether it's in low inflation or high inflation environments. Interestingly, bonds still tend to hold their own as well. Again, looking back in historical data, we see that bond prices may fall initially when interest rates rise, but over time, those bondholders are receiving higher levels of interest, which more than makes up for the initial loss in their price. So that's how we're thinking of inflation at the moment. It's ever changing and we're flexible. And so with that, maybe you can share with us what we're thinking about 2022.
Yeah, you bet. Well, for 2022, we do remain optimistic. So as we look at the marketplace and the economy, we still think there's more positives than negatives out there. And we've talked about some of those. We've talked about how consumers still have a lot of money to spend. They still are employed. And this should really keep demand high. And we think stocks will do well. It might be too much to ask the stock market to return another 20% for us next year, but we still think we'll have some positive returns for the stock market. The risks, which we've talked about, rising inflation, rising interest rates, those things could slow down the market and the economy. Different COVID variants have the ability also to shake things up as well. But overall, we are optimistic. We will start to, as you talked about, rising inflation. We'll pay close attention to that. We might have to make some adjustments to the portfolio if it persists. And bonds, nobody likes to own bonds right now because of the low interest rates that they're paying. They do serve a good purpose for portfolios still to provide that stability. But we want our clients to have that stability while also earning a decent return. So we've made a lot of adjustments to our bond portfolios this year. We'll continue to keep a close eye on that next year and make sure we're diversified enough and owning the right stuff as inflation persists. So thank you again for joining us today. Lance, thank you for joining us. Happy holidays to everybody. We hope you've had a great 2021. And we look forward to seeing you next year in 2022. Take care.